Having recognized that the open, O high, H, low L, and close C serve as the best way to summarize the trading action for the given period, we need a charting technique that displays this information in the most comprehensible way. If not for a good charting technique, charts can get quite complex. Each trading day has 4 data points, the OHLC. If we are looking at a 10-day chart, we need to visualize 40 data points. So you can imagine how complex it would be to visualize 6 months or a year's data. As you may have guessed, the regular charts that we are generally used to, like the column chart, pie chart, area chart, etc., do not work for technical analysis. The only exception to this is the line chart. The regular charts don't work mainly because they display one data point at a given point in time. However, technical analysis requires 4 data points to be displayed at the same time. The line chart is the most basic chart type, and it uses only one data point to form the chart. When it comes to technical analysis, a line chart is formed by plotting a stock's closing prices or an index. A dot is placed for each closing price, and a line then connects the various dots. If we are looking at 100-day data, then the line chart is formed by connecting the closing prices dots for 100 days. The line charts can be plotted for various time frames, namely monthly, weekly, hourly, etc. So, if you wish to draw a weekly line chart, you can use weekly closing prices of securities and other time frames. The advantage of the line chart is its simplicity. With one glance, the trader can identify the general trend of a security. However, the disadvantage of the line chart is also its simplicity. Besides giving the analyst a view of the trend, the line chart does not provide any additional detail. Plus, the line chart takes into consideration only the closing prices, ignoring the open, high, and low. For this reason, traders prefer not to use line charts. The bar chart, on the other hand, is a bit more versatile. A bar chart displays all 4 price variables: open, high, low, and close. A bar has 3 components. The central line, the top of the bar, indicates the highest price the security has reached. The bottom end of the bar indicates the lowest price for the same period. The left mark / tick indicates the open. The right mark / tick indicates the close. For example, assume the OHLC data for a stock as follows: open, 65. High, 70. Low, 60. Close, 68. For the above data, the bar chart would look like this. If the left mark, which represents the opening price, is lower than the right mark, it indicates that the close is higher than the open, close open, hence a positive day for the markets. For example, consider this: O equals 46, H equals 51, L equals 45, C equals 49. To indicate it is a bullish day, the bar is represented in blue color. Likewise, if the left mark is higher than the right mark, it indicates that the close is lower than the open, close open, hence a negative day for markets. For example, consider this: O equals 74, H equals 76, L equals 70, C equals 71. To indicate it is a bearish day, the bar is represented in red color. The length of the central line indicates the range for the day. A range can be defined as the difference between the high and low. The longer the line, the bigger the range; the shorter the line, the smaller the range. While the bar chart displays all 4 data points, it still lacks visual appeal. This is probably the biggest disadvantage of a bar chart. It becomes tough to spot potential patterns brewing when one is looking at a bar chart. The complexity increases when a trader has to analyze multiple charts during the day. Hence, for this reason, the traders do not use bar charts. However, it is worth mentioning that there are traders who prefer to use bar charts. But if you are starting fresh, I would strongly recommend the use of Japanese candlesticks. Candlesticks are the default option for the majority in the trading community. Before we jump in, it is worth spending time to understand in brief the history of the Japanese candlesticks. As the name suggests, candlesticks originated in Japan. The earliest use of candlesticks dates back to the 18th century by a Japanese rice merchant named Homo Munehisa. Though the candlesticks have been in existence for a long time in Japan, and are probably the oldest form of price analysis. The Western world traders were clueless about it. It is believed that sometime around the 1980s a trader named Steve Nyssen accidentally discovered candlesticks, and he introduced the methodology to the rest of the world. He authored the first ever book on candlesticks titled Japanese Candlestick Charting Techniques, which is still a favorite amongst many traders. Most of the candlesticks patterns still retain the Japanese names, thus giving an oriental feel to technical analysis. While in a bar chart the open and the closed prices are shown by a tick on the left and the right sides of the bar respectively, however in a candlestick the open and closed prices are displayed by a rectangular body. In a candlestick chart, candles can be classified as bullish or bearish candles, usually represented by blue/green/white and red/black candles. Needless to say, the colors can be customized to any color of your choice. The technical analysis software allows you to do this. This module has opted for the green and red combination to represent bullish and bearish candles, respectively. Let us look at the bullish candle. The candlestick, like a bar chart, is made of three components. The central real body, rectangular, connects the opening and closing price. Upper shadow connects the high point to the close. Lower shadow connects the low point to the open. Have a look at the image below to understand how a bullish candlestick is formed. As a trader, you need to filter information from noise. For instance, a long-term investor is better off looking at weekly or monthly charts, as this would provide information. While on the other hand, an intraday trader executing 1 or 2 trades per day is better off looking at the end of the day or at best 15 minutes charts. Likewise, for a high-frequency trader, 1-minute charts can convey a lot of information. So based on your stance as a trader, you need to choose a time frame. This is extremely crucial for your trading success because a successful trader looks for information and discards the noise.